What if I told you that a stock could lose 41% of its value in a single month, and that very same crash could be the exact signal that a massive rebound is loading right behind it? Sounds impossible, right? Most investors believe that when a stock bleeds out over 40% in just 30 days, the business is fundamentally broken. Game over. Thesis dead. But here's the twist nobody saw coming. During that exact same 41% price drop, this company quietly locked in $2.8 billion in guaranteed revenue from some of the biggest tech giants on the entire planet. Welcome back to Calvin Mateo, where we cut through the noise and hunt down the setups Wall Street doesn't want you to notice. Today we are breaking down IREN, the ultimate battleground stock of the AI infrastructure boom. This is a company splitting Wall Street straight down the middle, creating one of the most volatile and potentially most lucrative setups we have seen all year. So could this be the crash that triggers the comeback? Let's find out real quick. If you love deep dive stock breakdowns like this one, do me a favor and smash that like button and subscribe to Calvin Mateo. It genuinely helps the channel grow and it takes you 2 seconds. Alright, let's get into it. Let me give you the bottom line right now, before we even unpack a single piece of evidence. IREN is currently setting up as a high conviction, high beta buy. It is combining a massive fundamental re-rating with highly combustible market mechanics. We are talking about $2.8 billion in locked revenue colliding head-on with a dangerously high 22% short float. And if this plays out the way the math suggests, we could realistically be looking at a 100 to 150% price appreciation target over the next 12 to 18 months. Now, at first glance, this looks like a straightforward growth story. Easy money. But there's one metric we're going to look at shortly that makes this conclusion far harder for the bears to defend. So what could possibly rattle a setup this clean? Here's the thing, IREN isn't your traditional tech darling, not even close. They are right in the middle of a brutal high-risk strategic evolution. They are pivoting away from being a legacy Bitcoin miner and attempting to transform into a Tier 1 AI cloud provider. And they've painted a giant target on their own back, aiming to reach 1.2 gigawatts of power capacity by 2027. To prove they aren't just blowing smoke, they are rapidly scaling their leadership team. They recently brought on Eric Hammersley as their new Chief Information Security Officer, alongside a fresh Chief Product Officer and a Chief Development Officer to manage this enormous operational expansion. They are laying the groundwork for a completely different enterprise. But here's where the story gets complicated, because building data centers is easy to talk about. Actually monetizing them? That's incredibly hard. Then, on July 20th, the entire narrative flipped on its head. IREN dropped a bombshell announcement. They secured $2.8 billion in brand new multi-year AI cloud services contracts, and this wasn't some vague pipeline dream or a hopeful projection. This pushed their 2026 annualized run rate revenue target to over $4 billion. And here's the kicker that should make you sit up straight. 85% of that entire target is now officially under contract, locked in. And we are not talking about small-time clients scraping the bottom of the barrel. Their anchor clients now include Microsoft, Nvidia, Figure AI, and Perplexity, with a weighted average contract term of roughly 4 years. Think about that for a second. They essentially locked in half a decade of cash flow. So this is a slam dunk, right? Well, not so fast, because contracts on paper don't magically build physical data centers, and the market is absolutely terrified of one thing. How on earth are they going to pay for all of this? This is the number one fear for any investor staring down an infrastructure stock. Dilution. How do you pay for 50,000 massively expensive Nvidia GPUs without issuing millions of new shares and completely crushing your existing stockholders? And this right here is where IREN's management pulled off something genuinely remarkable. These $2.8 billion contracts are structurally designed to self-fund. They include customer prepayments that cover 45% of the required GPU capital expenditures. Just let that sink in. This completely shifts the risk profile of the entire company. Suddenly, the balance sheet doesn't look shaky. It looks like a fortress, boasting roughly $7.6 billion in cash and equivalents as of June 30th. That figure notably includes $1.7 billion in restricted cash set aside specifically for Microsoft GPU financing. In one move, they found a way to erase the immediate dilution fears that were haunting this stock. But could all of this brilliant maneuvering still be completely ignored by the market? because none of it matters if the street isn't pricing it in. So let's see how they're actually reacting. If you pull up the price action, you'll immediately see a stock experiencing a violent identity crisis. Earlier this year, at the absolute peak of AI euphoria, IREN rocketed to a 52-week high of $76.87. But then, as the broader tech sector sold off hard, IREN washed out into the low 30s. Brutal. Then came the $2.8 billion contract news. The stock immediately surged nearly 20%, testing that $40 to $41 resistance band before settling back down to roughly $37.07. And despite that Friday slide, it still held on to a 10% advance for the entire week. This chart is a pure high beta roller coaster, and what it's really telling us is that the market has absolutely no idea how to accurately value this pivot yet. And when you look at exactly who is buying and who is selling these shares, that confusion becomes even more obvious. Smart money controls about 41% of IREN, and right now they are locked in a massive tug of war. On the bullish side, you have institutions like Defiance ETFs accumulating a staggering 12.6 million shares in the first quarter. BlackRock increased its position by over 604%, adding 3.8 million shares. And Situational Awareness LP scooped up nearly 3 million shares. These players are aggressively buying into the neo-cloud capacity story. But here's the flip side. On that exact same token, heavyweights like Morgan Stanley, Jane Street, and BNP Paribas have been actively slashing their holdings, terrified of execution risks and the overhang of a recent $2.6 billion convertible notes offering. Wall Street is completely and utterly fractured on this trade. So who's actually right here? To figure that out, we have to look at where the analysts are planting their flags. And this is fascinating. Despite that deep institutional split, the 15 covering analysts are overwhelmingly in agreement. Almost every single one of them has issued a buy or a strong buy rating, viewing this recent pullback as a massive asymmetric entry opportunity. Cantor Fitzgerald just upgraded their target to $99. B. Riley is sitting at $96. H.C. Wainwright and Macquarie are both planted at $90, and even the consensus average sits tightly between $80 and $82.71. Now remember, the current price is hovering around $37.07. That means we are looking at an implied upside of 100 to 150%. These analysts are betting that if IREN can actually plug in these 50,000 GPUs, the stock will fundamentally re-rate, transforming from a cheap crypto miner into a premium AI cloud provider. But that raises the one question every investor actually cares about. What is going to be the trigger that finally sets off this move? And the trigger, believe it or not, is hidden deep in the underlying plumbing of the stock itself. Right now, there are over 76 million shares sold short. That's a 37% spike just recently. That means a massive 22% of the available float is actively betting against this company. And here's the part that should raise your eyebrows. Based on the average daily trading volume, it would take these short sellers 2 full days of non-stop, relentless buying just to cover their positions. This is a high danger environment for the bears. IREN is a coiled spring wound tighter and tighter. It is a prime candidate for a massive violent short squeeze on even the smallest spark of positive macro news. And if you don't believe me, just look at what the options traders did the exact second that revenue news broke. Historically, the options market for IREN has been incredibly bearish. We're talking a 50-day put-call ratio sitting at a sky-high 5.88. Pure pessimism. But the intraday options flip that followed the $2.8 billion contract announcement was absolutely staggering. The entire script flipped overnight. We saw over 53,000 calls traded intraday. That is 3 times the average volume. And even more importantly, this volume was heavily concentrated on the weekly $40 and $50 strike calls. Read that again. The options market is now aggressively pricing in violent upside volatility. But even a coiled spring needs a spark to release all that pent-up tension. And wouldn't you know it, we have a major one arriving this very week. For the week of July 27th, IREN's price action isn't just going to be about its own fundamentals. It's going to be heavily dictated by macro events acting as a leverage proxy for AI growth. First, we have the Federal Reserve meeting on July 28th and 29th, which will set the entire tone for market liquidity. But even more importantly, we have mega cap tech earnings rolling in from Meta, Amazon, and specifically Microsoft. And this is the one that matters most. Because Microsoft is an anchor client for IREN, if they increase their AI capital expenditure guidance, IREN will immediately catch a massive sympathy bid. They are tethered directly, almost umbilically, to Microsoft's spending habits. So if the macro environment lights the fuse, where exactly do the technical boundaries lie? Let's map out the technical architecture so we know precisely where every single battle line is drawn. To the downside, the hard floor and the lower Bollinger Band sits right at $34.03. Just above that, we have immediate support in the $37.30 to $39.50 range, driven by the 10-day and 20-day simple moving averages. Now to the upside. The immediate resistance is the 30-day moving average, sitting between $40.70 and $41.42. But the most crucial wall, the one that really matters, is right at $42.50. If the stock breaks through that level, the top target zone opens up beautifully, aiming toward the heavy moving averages between $47.47 and $48. With the entire battlefield now mapped out in front of us, it's time to build the exact trade blueprint to execute on this setup. We are treating this as a short to medium term swing trade, specifically targeting the momentum leading right into their August 27th earnings report. And for your entry decision, you've got two clear paths. Path A is the aggressive dip buy. Here, you enter right at current levels near $37.07, using the 10-day moving average as your support cushion. Path B is conservative momentum. With this approach, you keep your capital safely on the sidelines and wait patiently for a confirmed daily close above that critical $42.50 resistance line. That close confirms the bullish reversal is fully intact before you commit a single dollar of your cash. But regardless of how you decide to enter, preserving your capital comes down to one non-negotiable rule. Capital preservation is absolutely paramount when you're dealing with high beta stocks like this one. You must set a strict stop loss below $34. And why 34 exactly? Because the lower Bollinger Band sits right at $34.03. Breaking below this level constitutes a severe technical invalidation of the entire thesis. If that floor gives way, the technical structure is completely destroyed and it exposes the stock to a total free fall right back down into the 20s. You have to manage your downside tightly and mercilessly so that you can actually afford to let the upside momentum run wild. And if that upside momentum does take hold, exactly the way the analysts are predicting, here is precisely how we scale out. This is an asymmetric risk to reward setup fueled by an undeniable fundamental re-rating, and our profit realization happens in three structured, disciplined steps. Target 1 is $42.50, representing that near-term resistance test. If it clears that level cleanly, we hold for target 2 at $48. This is the major technical breakout line and the exact zone where a short squeeze could trigger a massive cascading effect upward. And finally, for the long-term holders who are willing to wait 6 to 12 months, the ultimate goal is $79 to $80, filling that entire Wall Street consensus gap. So think about where we stand. The blueprint is laid out. The prepayments are secured and the shorts are trapped in a corner. Now, we manage our risk tightly and we wait for that macro spark to ignite. Now, before we wrap this up, I have to give you the important stuff. Everything I've shared with you today is for educational and informational purposes only. I am not a licensed financial advisor, and this is absolutely not financial advice. Stocks like IREN are extremely volatile and carry real risk. So please, always do your own thorough research and consider speaking with a qualified professional before putting a single dollar into any position. Your money, your decision, your responsibility. All right, that's the full breakdown. So now I want to hear from you. If IREN actually breaks that $42.50 wall and the short squeeze ignites, how high do you think this stock realistically flies by the end of the year? Drop your price target down in the comments below. I read every single one and I genuinely love seeing where you all land on these battleground plays. And if this breakdown gave you a fresh edge on IREN, do me one last favor. Hit that like button, subscribe to Calvin Mateo, and turn on notifications so you never miss the next high conviction setup before the crowd catches on. Until next time, stay sharp, manage your risk, and I'll see you in the next one.